Any information presented and discussed in this meeting, including forecast, financial information, is for educational and entertainment purposes only. It should not be considered as advice or recommendation to investors or potential investors in relation to holding, purchasing, or selling securities or other financial products or instruments, and does not take into account your particular investment objectives, financial situation, or needs. Before acting on any information, you should consider the appropriateness of information in regards to your own particular situation, and you should seek independent financial advice. Neither Stanzink nor any of the presenters will be responsible for any losses incurred by anyone acting on the information. So yes, please use your own judgment. We are going to talk about financial ideas. Doesn't mean we're recommending you to do anything with investing or trading. I will now stop sharing. And well, I would like to introduce Tom Aspray. I follow Tom with his articles and in Forbes and in YouTube. He's, for me, he's a true technical analyst. He looks at the technical indicators and he gets very good, I think, accurate recommendations. And I particularly think, Tom, you're an expert in the advanced decline indicator. I don't know if you're going to talk about that one today, but otherwise, members, please check his articles on Forbes and his videos on YouTube, and you'll get a good idea. So, Tom, I leave up to you to talk about trading bear markets, and you'll give us an idea of whether you still think this is a bear market or not. So I leave this
Certainly will do that, Pablo. Thank you very much for inviting me. It's a great pleasure to speak to your group, and thank you for the kind introduction. Yeah, a little background might be helpful. I was originally a biochemist, and so I was doing protein analysis for many years and was using a computer to analyze. We're trying to determine the three-dimensional structure of a basic metabolic protein, and we needed computers, in the late 70s to analyze that data. And so I became fascinated with computers and bought an Apple II, which was the state-of-the-art computer back in those days, and started manually inputting data from a publication called Barron's. So I could trundle down to the library and get 6 or 8 issues of Barron's and transpose. I think I was probably doing 12 to 15 different indicators that I'd read about, but you couldn't, back in those days, there was no access to those things. This was in the 80s. And I took that research with me on vacation to Hawaii one summer, and lo and behold, I ended up with a job offer. And so I was offered a job in Hawaii, and since I was living in Oregon at that point, and Oregon, as you probably know, is quite rainy. I think the prior year we hadn't seen the sun for 60 days, so it seemed like a great opportunity to get out of the rain and change my focus. And but people have asked me, well, why technical analysis? Why the financial markets? And what always appealed to me about biochemistry was you never knew everything. There was always something different. And that's the same way I felt about the financial markets. No matter how long, I study them and how well I work with them, there's always a surprise. There's always a different wrinkle. And so, pretty much I became a technical analyst without really any preconceived notions other than Edwards and McGee. And that was sort of the basis. So that's kind of where I'd like to, start my presentation. We'll try to see if we can switch to the PowerPoint, and let's see if I share my screen here, and we should, you see that okay?
Yep, we can see it.
Great, good, that's good to know. So how I, in the late 70s and early 80s, I started getting interested in the financial markets. Part of this was due to my father was a very serious investor. Many of you probably are too young to have been trading the 73, 74 bear market. I certainly wasn't trading at that point, but it was 6 years later I started studying it because my father was fortunate enough to be buying a bunch of stocks. Let me turn my pointer on. Right down near the 74 lows. And so I was quite impressed that he gave me some of that stock, and it had gone from 3 to 20 or something. So I thought that was a pretty intriguing prospect. So just a little background, sort of interesting, you might find out. This was a little different than most bear markets. You typically will have a first push to the downside we'll have a rally that looks stronger than this. Back in those days, we had something called a Nifty 50. And that was, the market was powered higher by that, similar to, I think, in my estimation, what we have in FANG stocks now, a narrower focus. But this bear market dropped the Dow 44%, and we never got above this high for 8 years. So it was pretty devastating. And one thing I'll focus on today is how bear markets and bear market rallies can really change the sentiment of a market. I talked to people 10 years after this, in the late 80s, because I was giving lots of presentations. They were still avoiding stocks because it was so devastating. I mean, you can see some quotes. McDonald's was down 72%. Coke was down 69%, and Avon was down 85%. Most people during this period invested in mutual funds. That was, they weren't ETFs. The individual stocks were more for professional traders in those days. But there was a guy named Chuck Royce who was a very successful mutual fund manager. He took over this fund right around in here. It was down, I think, 48.6% in 73, and then lost another 46% in 74. He later became quite successful, but you can imagine it was a pretty devastating. So that intrigued my interest. And then when I moved to Hawaii, I had the capability to look at all these markets in more detail. And many, of course, I went back to the 29 drop and what happened there. I was able to study it. And you can see this is the S&P. Most people don't really understand that this drop was actually fairly short in terms of time. And the bear market rally here was actually quite a bit longer. We rallied from November up into April. And, that was, the commentary you'll see as that occurred was really dramatic. It's at the end of the presentation. I'll give you some of the quotes you can see from history, and the sentiment changed totally during this period. It went from the worst thing ever happened to up here, like, that 1929 crash wasn't a crash, it was a buying opportunity. You can imagine that difference. So the best thing that happened when I went to Hawaii was the fact they had a computer software system called CompuTrack. It was developed by a man named James Schmidt and Tim Slater. I'll show you a picture of Tim and his late wife, Willa, later on. And they had a technical analysis group, and it was the only technical analysis software available in the early 80s. And they had almost everything indicator on there that you would find in stock charts or any trade navigator. They had all of Wells Wilder's indicators, etc. And so I spent a couple of years looking at various markets, trying to find out those indicators that work best in up, down, and sideways markets. Amongst, literally they had about 45, 50 different indicators and methods, some of which, are still sort of obscure. You can't, they don't have the software anymore, but if you looked at the directory, you would be shocked. And so it was a really pivotal moment for me. We had a database. I could look at any market I really wanted to at that point, and also had the ability to attend one of their conferences in the early 80s. And then I was invited for a speaker at an annual conference. It was sort of like a graduate level technical analysis conference. I think 83 through 2000, I think I spoke at every one of them, and they were fascinating. And as a result, Tim Slater put on a bunch of overseas talks. I think the first one was in 1986, where I went with John Murphy and Martin Pring and Barbara Diamond. The four of us flew to Australia. I think, as I mentioned in the pre-comments, that it was a pretty long flight at that point, and we unfortunately did not stop in New Zealand. He took a group to New Zealand subsequently. I just wasn't included, unfortunately. But it was it was an eye-opening experience. We went to Sydney and Melbourne and Singapore and Hong Kong on that particular trip, and subsequent they had much more exhaustive trips. So when I started looking at some of the data on these charts, this chart's through Trade Navigator, one thing that stuck with me was the fact that I looked at the chart patterns first of all. And this is sort of an example. So this is the rally in 1930, peaked out at this point A, with a sharp 15.6% drop, 12% rally, sort of a flag formation as line B and C. Another push to the downside. So down here we're down 27%, from the high here. And, this is more typical of a pause in a downtrend. So if you look at classic sort of technical analysis, these are all continuation patterns, whether you call it a flat or a triangle. They're a pause in the ongoing trend. And I discovered that they were often the most, lucrative and successful patterns to trade, because if you were right on the major trend, you got pretty clear signals when that trend was resuming, whether it was an uptrend or a downtrend. So these, in a bull market, these are pullbacks or pauses, or dips, if you will, in a bull market. And, so when you break out of that pattern, just as the case here, you can, old trick way back in the day used to be to, flip this chart and look in the mirror, and you could turn this into an uptrend, of course. So, another sharp plunge down 46% at that point. This rally, and what my view is that whether it's a pullback in a bull market or a rally in a bear market, it serves to really change the sentiment of the market. And that's certainly what we've seen this time. And at the end of the presentation, I'll get you into the current, view of what I think is going on now. So if you carry this chart into 31, it didn't stop. We had another, broke that uptrend after that 3-month rally, another huge push to the downside. I found that, you could look at the bear market rallies or the bull market pullbacks and look at the classical sort of resistance or support levels where you'd expect them to hold. You usually had to go, in other words, if you went, this level here, that would have been too low. You had to really give the market a lot of room, because the contra trend move would often be stronger than you expected. So then we got sort of another flat here, and we get plunged into October. You can see this little highlighted section when this latest rally started on March 23rd. You may have noticed that there was a bunch of comments in the U.S. press anyway, probably filtered. You probably saw them as well, at the strongest rally since 1931. Well, whenever I see that, I go back to find that time, find out what was going on, because I fascinated, because usually you don't see, oftentimes you see they'll make it have the financial media will make it look like it was a very bullish or a very bearish sort of development that triggered it. And if you look at the actual what was going on, then it wasn't. So this was the rally. It was like 2 days up, and you can see this was a 33.7% rebound within the market. And of course, it lasted about 6 weeks, and then bam, we hit back down again. So I happened to be able to find this article in the New York Times, and it was, market scores sharpest rise in 2 years on news of Hoover move for recovery. Well, Bill, you study history. Hoover had a bunch of plans, but they were kind of half-baked, if probably kind to Hoover to say that. But obviously, they didn't work. But they thought, it was like, oh boy, we got it here. So economy's going to turn around and things will be great. So that's the market rally. So as I started using CompuTrack, a couple of things that really impressed me. One was volume, and the other was the advanced decline line. I'd read about the advanced decline. I kind of knew how it worked. So this is sort of my basic chart. So this is obviously a weekly chart of the S&P 500 on the top. Down below here, we have what's I refer to as the NYSE all AD lines. So the NYSE composite, was at, up until about 2000, that was the only advanced decline line we had. Now we have the S&P and other markets advanced decline lines, but they don't go back into the, they start in 2008 basically. So essentially the NYSE is really a mix of stocks, ADRs, bond funds, closed-end bond funds. And so many people that who think the advanced decline line doesn't work, that's why they don't like it, because it has all these other markets in it. So this red line here is the advanced decline line. And this green line is a 21-period front-end weighted moving average, not exponential, but front-end weighted. And so when I started in technical, I looked at indicators just like a price chart. So I looked at support, resistance, and I ran moving averages over. I didn't, there was no sort of, like there is now, there's more of a classical sort of preconceived notion of how you should do technical analysis. Back then there wasn't. So, I looked at divergences. So, we had the market move up sharply up into March of 87, a pullback below that moving average, sort of a normal sort of correction here. Another sharp push to the upside in August. But as we got into August, you can see that the AD line formed lower highs, line B, while prices find higher highs. Classic negative divergence. So once we, drop below the moving average here in the end of August and early September, that was a sign of weakness. And you can see the market really went sideways for about 4 weeks before the plunge, in October that's so famous. And really we stayed below, the moving average on a weekly basis until January of 88. So it's a pretty good size move. As we look at slides during the presentation, you'll see there are a lot of familiar and reoccurring patterns, which is what I really focus on. And of course, I look at this on different time frames. So what is the advanced decline line? For those of you who aren't familiar with, every day you can see this kind of data. So this is from a week ago, Tuesday, the June 2nd. This is a free site on the Wall Street Journal. It's about the best one that I've found, frankly. There's 2 of them. And, if you my email here, if you don't want the link and you can't write this down, just send me, send me AD line. I'll send you both of them. One gives you the daily and is updated during the day. And this one gives you the after the close. So this gives you, in that case, this was Tuesday the 2nd, and then this was Monday, the prior day. It give you the number of advancing stocks versus declining stocks, and also gives you unchanged and new highs, new lows, up volume, down volume. So 2175, 767. So the advanced decline line is a cumulative total. It's really not important what the absolute value of the AD line is. It's the relative, the trend, if you will, of the AD line. So a day like this, you'd take that difference, 2175 minus 767, you'd add that number into the AD line, and that'd be your value for that day. And you can see that the prior day you also added in, roughly 1,400, issues or so. And that's what we're looking at, is that. So why is that important? Well, if you look at it in terms of what happens between a bull and a bear market, you see that transition from from a bull market top that we'll look at, that you start to see, more stocks are advancing than declining. And as you get to a market peak, then it started the sellers take over and they're more declining stocks than advancing. So that balance shifts. Early in this current crisis, this was sort of thought to be an event-driven bear market. So I look back in history. Of course, we didn't have candle charts back in 61 or 62. This was early in the Kennedy era, but it was sort of a typical pattern. We got a 8% drop. This is a weekly chart. So it was, it was a 6-week 8% was still enough to get people's attention. Then we had the 5.8% rebound here. Down below that, we can see the AD line, it had peaked already. And as the market was making a new high here, it was making a lower high. So we had another negative divergence. This line A, drop below the moving average. Typically when you get a change in trend, you'll see sort of, this rebound or pullback, depending on whether transitioning from down to up or up to down. The AD line won't move much. So you can see it was really flat right in here, and then we broke below the moving average and the support. We were down 29, 30% in a short period of time. This sort of pattern is quite common. I can take you through daily charts. In fact, I'll reference an article later. You can see this sort of similar. We saw this in 2016, 2012, lots of times. You get a 17% rally, and then you get a drop back. You want to always make new lows, and oftentimes you won't see a divergence, based on the weekly data. So you can see the AD line made a new low here. But how I look at it is that, your trend is below the moving average and negative, starting to improve a little bit, but then you turn back down. So this level D becomes a key level of resistance. So just like a price chart, if you're looking for a breakout, I'm looking for a breakout to the upside in terms of the AD line to signal that trend has changed. So we got it back above the moving average. So, this was this was March of 862. By November of 62, we're turning back higher. And, it's pretty by by early in the next year, we were up 27% from the low. So similar sort of thing in 66. Also, we had, you can't really see that whether there's a divergence. Now we break below that moving average, we get an 8% drop, a 7% rally. AD line doesn't budge. So that was one of those instances where prices can move higher, but most stocks are not pushing it up. And there are lots of instances. That's what the AD line, and in my estimation, is a leading indicator. So it's telling you in advance what's going to happen up or down. In that particular instance, we got another 20%, decline. The AD line, probably peaked or bottom a couple of weeks before prices. And, once again, the resistance or the patterns won't look exactly the same, but similar. So, you look at this last peak here, that's the key level of resistance. So, you see a transition here from more stocks advancing. Now, advanced declines are about neutral, and now more stocks advancing, and the AD line turns positive. So you can look back at this through history. I don't know if any of you look at stock charts. It's a pretty good data source for this. They have this chart goes back into the 90s. And this symbol here, $NYAD, this is the only place I've found that updates graphically during the market day. You can't do it intraday, but you can look at the daily numbers. So if you're looking at them, last couple of days, you'd see, by 11 o'clock yesterday that the advances declining were wildly, positive. And so it kind of gives you a cast. So down here, we have in green this time is the advanced decline line, and the blue is the 21 period weighted exponential moving average. Stock charts does not have a weighted moving average. Surprisingly, it makes a minor amount of difference when you're looking at daily data in between the two moving averages, but that's sort of a minor point. But basically, you're looking at the trend. So we're above that moving average. We see a pullback here, just below the moving average, another push to the upside. AD line continues to make new highs, a little more severe correction here. Once again, a new uptrend, higher highs in the AD line, higher lows. So you're clearly in an uptrend. You get into, 97, very strong. So when you see this sort of the slope, if you will, of the AD line, that's usually an area where you can really, pretty much, use pretty wide stops. And these trends can often last. We saw one in 2019. It lasted about the first 3 months of the year. So they can, 10, 12 weeks is not uncommon. Everything was fine until 98. We got a new high here, new high in the AD line, but then by July, we'd made a new high in the New York Composite, but the AD line here had formed a lower high. So it just rebounded back, to its moving average. So at this point, we're transitioning. So now the declining stocks are starting to take over. This is how it looked on a daily basis. This was the Russian ruble crisis, and it was a big shock to the markets, and the interest rate markets just went crazy because of the ruble. And you can see that, the rally in July here, the AD line was right here. It was not above the June peak, and we broke support. It's pretty severe decline. You can see a similar sort of pattern we just saw when we were looking at 61. Sharp drop. We got to see about a 2 or 3 week rebound, right back up in here to resistance. If you looked at this in terms of Fibonacci, which we will in other instances, it's probably about a 50% rebound. So those levels do work. Another push to the downside at that point, there was a hedge fund called Long-Term Capital Management that was run by 2 Nobel Prize winning economists who were set it up to capture very small differences in interest rates, never dreaming that those spreads would ever widen out. And of course, they did when the Russian problems roiled the global bond markets. And so it was a small bailout in terms of our current environment, which is a couple $2 billion to get it back on float. But no real divergences there at the low. So still we had a downtrend. I look at downtrends as well as resistance. So we had a downtrend, that was broken. Typically, and I'll show you a little bit later, you see a transition. So you go from daily, we'll turn first, both negative and positive. Then you look at weekly, and then you can even look at monthly. So we broke the downtrend, the moving average, then, right around in here, we moved above this peak. So that was a sign that, it was the trend had moved back to higher. So I look a lot at these corrections. I threw this one in because this was during the Ebola crisis in 2014. it's another good example and some similar patterns. So, September of 2014, S&P made a new high. We had a little pullback, made a new high here at 2019 in the S&P, and you can see the AD line formed a negative divergence. So then when we drop back below the moving average, that's usually a warning sign. So what I generally do is you never really know early in the stages whether it's just going to be a consolidation or a decline like this one. So I usually pretty much tighten stops on long positions or get out of the long side, maybe venture in on the short side till I see what's going to happen. Sometimes it's just going to be a trading range when it drops below the moving average. But then once you take out this low, then you have, a high, a low, a lower high, a lower low. So you're in a clear downtrend right in here. And so this was a 9.8% drop that just, lasted about a month. I think this was like October 15th. Everything came back to order. And, by November 3rd, the market, made a new high, and the AD line, look at it, it already made a new high. It made a new high right in here. And so it led the price action by about a week. That will often be the case. We're seeing a new example of that just now. So if you're interested in learning more about this, is on my website, viperreport.com. It's also on Forbes, I think. So if you look at Survivor's Guide to Market Correction, I think that's the only article of that name. So there are a bunch of them. This was the 2018 example, and we'll talk about it was similar to what we saw this year. I'll talk a little bit about the Stark bands. That's these green bands I didn't really explain earlier. And they are different than the Bollinger Bands, but they tell you when it's a high risk time to be buying or a high risk time to be selling. So when they're near the upper bands, the probabilities are that you're containing about 93% of the price activity. So I use them to take profits when I figure the market is dangerous and dangerously oversold or dangerously overbought, and also to cover short positions. So you can see in February, we had this sharp 11.8% drop in like a week and a half. And we got down into, and the market reversed. You can't really see it, but this day right here, we were sharply lower and then actually closed higher. I was on a Friday, and I looked at the AD lines, and the AD lines were stronger than prices. You can see the price was here, much lower price, but AD line did not make a new low. So that was a sign for me that traders should get back in the market. Took a longer time frame before the major trend was resolved. You can see this sort of broad trading range in the AD lines. And this is one of the 6 AD lines I follow. So now I follow the S&P, the NASDAQ 100, the Russell for small caps, the Dow AD line, and then there's 2 AD lines for the NYSE, which we'll get into in a second. So why do I follow all of those? Because it gives you some idea of sector. So it tells you, like right after Trump was elected, it was clear that the AD line in the NASDAQ 100 was looking much stronger than the S&P. So that makes me favor the QQQ over the SPY. Conversely, oftentimes the small caps, or the Russell, the IWM, will lead both up and down. So, there was a period in 20, where the small caps lead, but also earlier this year, I think I pointed it out in the Forbes column that they were starting to break down in January. So they were sort of giving an advance warning of what might be coming. So that's why it's advantageous. All the data pretty much is available on stock charts. And so I don't have any deal with stock charts other than 2 old friends, John Murphy and Greg Morris, both own a part of stock charts. It's about my only connection. So here's another, let's kind of take you through the transition. So this is a transition from the bear market of 2000, into the bottom at 2003. So you can kind of see we moved down here, and we sort of dropped below the moving average, and then we had a rally up in here, and then as we got to drop back towards the lows here, the AD line was really not, didn't make any lows. It really wasn't technically a divergence, because there was not a new closing low or a intra-week low at that point. But then you look at the same sort of thing. So these, this peak here was the first level of resistance. So you move above the moving average, and you can go into stock charts and you can put these data in there, and you can blow this up and you get lots more detail. for those of you who are familiar with stock exchange, you can put in like, starting in, February '02, up through, say August of '03, and using this NYAD, you'll see exactly this, and you'll see that there was a lot of, there was levels of resistance. So this was the first one. This was the second one. We started to overcome them in 2003, in the spring of 2003, and then it was pretty much a very strong market. And there were pauses in here. You can see that this was a pretty substantial correction. I mean, this lasted from, I think, March, through August. But if you notice the AD line below this, it bottomed midway. So even though the NYSE Composite made a new low here in August and September, the AD line was back above its moving average when that happened. So that was a sign that this price decline was not met by a lot of declining stocks. In fact, there were more advancing stocks during that. So you by looking at the price itself, you really didn't tell that, but the AD line told you. So, the rally continued. We're still seeing that pattern of, higher lows, higher highs, as we get into 2006. And there were certainly corrections along the way. We dropped below the moving average a couple of times, but those were all short-lived. And you want to look back at that previous peak and say, well, okay, is the AD line making continued new highs? Okay, then that's positive. So let's look at what happened, going into the top in 2007. So you can see that same trend we just talked about. Everything was pretty fine until June of 2007. You can't see it in this, but you'll be able to see it look clearly in the daily chart. The next slide. The AD line peaked in June, and then we moved up higher in July. AD line was slightly lower. Sharp decline in August, and then on the rebound back into October, you can even see in this chart that the weekly AD line formed lower highs here. So once again, we were seeing that same negative divergence, and that was a sign of trouble. If you look at this on a daily chart, it's even more pronounced. Okay, so we have the New York Composite. One of the few moving averages I run is a 20-period exponential. I just find that I look at some of the other numbers because a lot of stock traders in the U.S. follow 50-day moving averages, but I really plot it. I find that I look at the trend of the 20-day and the 20-week EMA for help with determining the trend. So if it's sharply declining, like it is right in here, I usually conclude, well, it's too early to look for a bottom because you're going to have to see that narrow and flatten out. So, I look at it as sort of a guide, keeps me on the right side. You'll notice that the 20-period exponential often acts as really good support, whether you're looking at a daily or a weekly chart. And so that's why I run. So this is the June high in 0.1. You can see below here in green, we have the NYSE, the all AD line. I separated it out at this point because we then had a new set of data to look at. So this is all the issues that are traded on the NYSE. And with a 21, once again, exponential moving average for stock charts. Down below it in red, we have the stocks only. So this is just the stocks in the NYSE, the AD line of the stocks. Shows you similar patterns most of the time. Sometimes it doesn't. It formed lower highs than the start of this year, and which was a good tell at that point. But so we both made a new high here in June. July made lower highs, 0.2. The sharp decline, you can see by the decline in the AD line, there was some really heavy selling here that was taking place in August. And so on the ensuing rebound into October, both AD lines were much lower. In fact, if you connect these two highs, you'll see we just hit this downtrend at 0.3, even though all the major averages, where you look at the S&P, NASDAQ went under NASDAQ Composite, they were all making new highs in early October of 2007. AD lines weren't. So we had the weekly divergences and we had daily divergences, and in both series, and that was a sign that we were transitioning from a bull to a bear market at that point. Any questions I need to be dealing with, Pablo? You see anything good in the chat room?
No, there isn't any. I've got a small question. So you've got here two AD lines. One is all and the other one is stocks only. The all, what would it also include apart from stocks?
So in the NYSE Composite, they have ADRs, for foreign companies. They have bond funds, closed-end bond funds, so they just hold a group of bonds, so they fluctuate I mean, some they trade at a discount to a net asset value. So if you pull up a bond fund, it may be a lot of favor because whatever bonds it holds. So it's trading at a certain price, but if you group up all its components, it's actually worth more or less than that. So they're not traded like stocks. They're not active as stocks are. So it's a mix. And I should have included. I have a great cover from somebody who wrote an article about why the NYSE advanced decline line in, I think, April of 2016 should be ignored, which was based on my work. It was a really bullish time for the AD line because of that mixture. And, it's, I mean, I can understand their point, but that's not what I've observed, looking back at 50 years of history. It's a pretty good indicator. And frankly, you're looking at, I think you get some more information with the stocks only AD line, but it's not like one is always right and the other one's always wrong. It's a kind of a mixture. For example, in September of 2018, the all AD line diverged on September 21st, but the stocks only did not. So you got a negative divergence with one, but not the other. So it's different in that regard. So that's why I follow, as I said, there's 6 of them I follow, and they give you a different impression of the market and what's going on there.
Great, thank you.
Sure. So here we have sort of the transition, looking at a weekly chart. So here's the high in October, lower high, and this is the all AD line again. That's only available on this platform. Lower high, we drop below the moving average. We had a pretty, steady decline into March. This rally doesn't look like much, but as I'll talk about later, it was quite enough to change the sentiment. So it actually interestingly went from like March 17th up till early June, and then we saw the decline really resumed here. In the summer, before the Lehman Brothers, etc. AD line was just looking really sick, but not much price activity. So we got down into late 2008. We had a low. We looked at the first high from that. So that was kind of the key level of resistance. Early March, we had another new low in the AD line and in price. These are the Stark bands. So you can see that, when you get down to these lower bands, you'll often move sideways or rebound. And, so that's what we did in here. This was the Lehman Brothers. We consolidated for about 4 weeks before another wave of selling. So in early March, there's the first sign of maybe a turn was when we moved back above the moving average. That's kind of like phase 1. Phase 2 was when we moved above that peak. And then phase 3 was when we broke the major downtrend here, from connecting the May 2008 or the October 2007 and the May 2008 peaks, which we broke in this, I think, September or so. If you look at this on a daily basis, once again, we didn't have the stocks only data available during that time frame. You see the same sort of behavior. This gives you the daily chart, shows you, kind of what we slid down through here. Once again, with the Stark bands, the daily Stark bands. So we look at peaks and valleys here. Pretty much, no signs of a bottom really here as we got into November. A rally here that, you can see a level of resistance in the AD line developing here. So then, on March 13th, the AD line moved above its moving average. So it's about, not less than a week, a few days after the low. So that was the first step. Then we kind of overcame this resistance here, on April 24th. So a little over, a month after the AD line moved above its moving average. Moving average, the slope of I haven't really talked about, but I look at a lot of the slope. So usually when it's rising this strongly or falling this sharply, I don't look for a change in trend. I look at moves back to that moving average as an opportunity to establish a new position. So then finally in July, we had a trading range, and then we broke out of that trading range in the middle of July, July 14th. That was a very bullish signal, and that was sort of more the all clear sign for the overall market. So that kind of takes you through, looking at both the weekly and the daily to see what kind of transitions, you can expect. So I often, for people who, what's the purpose of a pullback in a bull market or a bear market rally? And I think it's like changing the sentiment, as I talked about earlier. One way that I track this is there's a group, the American Association of individual investors, AAII. So you want to Google this. I mean, they do their survey every Thursday morning. So, I mean, I'm up usually about 3 a.m. on Thursday morning. Their site gets bombed sometimes. So sometimes you have to wait till more like 7 a.m. Eastern time, US, to see it. But then you'll see the numbers, their sentiment numbers. They generally work pretty well as a contrary indicator. I place a lot more emphasis on the bullish percentage than I do the bearish percentage, as it's generally much more reliable. And it hasn't been the case this time around, as I'll discuss in a few minutes. So basically, this was the 2007 October peak. 54.6% of the people they surveyed were bullish. Okay, that's in the .com it got up to 75%, but rarely now do you see it above 50%. 55. I think this bull market has been the highest. So we got a pretty sharp decline here into the end of the year, a rally to start in December, January. By the time we got this is early January, now only 19.6% were bullish. So 54.6 to 19.6. You can see the market dropped for the next week, but at that low, the next week there were fewer, the people were less more bullish then than they were up here. 19.6 bullish, 25.4 bullish down here. That's not uncommon. You will often see it bottom before the market does. That set the stage for a dramatic rally. Usually, my experience, and you can pull their data down online. So you go online, they'll give you a Excel spreadsheet going back into the 80s of all their data. 19.6 is under 20 is usually pretty. That's a pretty low number. And so when I see that number, I start looking for signs from the technical indicators to confirm, because oftentimes it's too early. For example, in 2018, I think it was just above 20%. Like on December 10th, the market dropped for another 2 weeks. And so if you were trying to buy the averages, you got creamed, going into just before Christmas. But you're getting an early warning here from the bullish percentage. So in any case, we got a pretty sharp rally up in here into February, 34.3%. We're now bullish up here at this 0.3. And by the time we made the March low here, it was back to 20.4% bullish. So, most people, I didn't record the bearish levels, was probably 45 to 50% were bearish, only 20.4%, were bullish. At this particular point in time, I was actually, in addition to writing market commentary, I was also doing interviews with investment newsletter writers and investment experts. So I interviewed a bunch of these gentlemen early February, right around in here. Pretty much everyone thought we were in a bear market, and we're pretty, negative on where stocks were going to go. We'd had, the housing crisis had really picked up some steam, by the guys that measure the start of recessions. This was the official start, was right around in here. You didn't know that at this point. I mean, it's like we just got that news yesterday that the U.S. economy went into a recession in February. So it takes a while before they make their formal declaration. But in any case, they were all pretty bearish. So you can see we got 20.4. By early April, we're up to 45.8, and then, kept going. So early May, 53.3, we're now bullish, 52.8 at this point in here. Well, I was doing at another conference, interviewing some of the same folks that I was interviewing back here. Now they were pretty much all bullish. A couple of them wrote articles that what bear market, there's no bear market. And so as the market peaked here at 46.3%, that was the actual high. And of course, it tailed off, from that level. And so it was pretty dramatic to see all these, essentially this rally had lasted long enough to change a bunch of these people's, positions. And of course, one has to also factor in, if you're writing a publication, for clients, that if you see a trend that goes against what you're thinking for a while, then, typically you'll lose clients. So there's economic pressure to change your mind. So this is what you can look at in stock charts. So this is current as of last week. So bullish percentage, you can see here's a symbol is, you can search it, you can dollar, exclamation, AAII, bull, bear, etc. So this is what I was talking about in early 2018. So we peaked down here to 20% a week or two before the market made its low. The bullish, not so good generally. And so, both in the May, we had a really nice correction in May. It was perfect. I didn't include any charts, but if you look at the AD line analysis, you really got that feeling, in late April, early May, that we were going to see a correction. And we went from, over 45% bullish down to about 20%, or I think 25%, bullish during this 4-week decline. So there were several opportunities in 2019 when we got down to these lower levels. Wasn't too high. It was at 45% just before we peaked. What was different this time around was when we had this huge selling, and the selling was by all amateurs and professionals alike, was pretty extreme. And some of the, when you see something like utility, something fairly, usually with a low volatility, plunging as much as it did, it was really surprising we never got down, much below about 25% at that low. So it never got very oversold. It started to get a little oversold right around in here. We got down, I think, to 23, and now we're at 34.5. So this is not normally, I've looked at this data going back, as I said, into the 90s, and this is an odd pattern. The bearish percentage rather acts more normally. You get this twin peaks. It got to be pretty, bearish, right a couple weeks after the low, and it's dropped off, but it's still pretty high. So this is normally a pretty reliable indicator. Right now it's sort of a head scratcher, frankly. So you can look at two possible, if we've had this dramatic rally and we don't see a sharp rise this week, up to above 40 or something, then it's going to probably look a little more suspect. It'll say that, well, the people in this survey anyway are not buying this market action because they should be up here in the 45 range. So, but once again, you need to use whatever sentiment numbers you're looking at, what sentiment indicators, you really need to look at the technicals for confirmation, because contrarian stuff only works, in my opinion, if you have something that corroborates or supports it. So let's look back. Typically, what you would expect to see at the end of a bear market rally. We haven't seen that this time. I thought we were going to, and I'll look at some of those slides. So you see that low from the AD line again in March. You can see that the daily Stark bands sort of work pretty well here. We had a low in the AD line, so we're starting an uptrend. So clearly, by here we're in an uptrend. The sentiment, as I mentioned in an earlier slide, continues to get more bullish. It peaked right around in here. Made a new rebound high here. This was a level. I think the high here was was just over the 50% retracement level. We formed a kind of a doji up here near the upper band. You can see the AD line started to break its uptrend, moved above and below its moving average. Finally, the moving average started to turn over in June, and that's when it was clear that the bear market rally was over in 2008. You can also look at this in a momentum indicator. This is Jerry Appel's MACD with the MACD histogram. Jerry was a very creative guy. When I started using the MACD in the early 80s, he had already moved on to other tools. And I had the pleasure of speaking with him at a conference, and I told him what a great indicator was for currencies. He kind of looked at me like, "You must be nuts. You're using these to attempt," because I was running currency analysis, and I was really on a weekly basis. It was a really, no one was, of course, I don't think, probably a handful of people in the world were looking at that point, but it was very good. So, you got a very nice divergence here, higher highs in price. This was the high here, was like at 1441, I think, in the S&P, and the 61.8% retracement level was like 1452 or something. So you get the divergence, and then you start to really tail off here, and you get, it can be a pretty good trending indicator. It's one of the, if I don't have volume data, that I look at the MACDs. So no matter what bear market or bull market you look at, you can see some similar sort of Fibonacci relationships. Being a scientist, of course, I'm well aware of all the Fibonacci and relationships in nature. So it was pretty natural. This is the major high in the Nikkei, 38.98. You look at this first drop, This rebound just sort of tailed out right at the 38, just above the 38% retracement level. You got another huge downdraft. You can see same sort of patterns. You remember that first little rally we got in, off the 29 high, and then this more longer term pattern, that was resolved to the downside too. And I use, triangle, projections. I find they work pretty well. So, you have this nice flag formation. So I measure this distance, and I measure it right here to here, and then I measure it from like here to here. So I have 3 distances. So you subtract that from the breakout level, you get a downside target. In this case, you're doing 3 measurements, so you get 3 downside targets. So the last one, I look at the numbers there, but let's say roughly 25,000. So it probably was like, 17,000 or something. But it really does work. And why do I use it 3 different values? Because I want to look at, that, hey, maybe my worst case target will not be hit. So what are the other targets? This is back to the 29. You can see that we got the same, this rally we talked about up into, April of 1930 here. It was just above the 50% retracement level, 290.43. We got to 297.25. So that was a key level. And then, you can see the sort of flag formations and things we got on the way down. So back to 73, 74, you can see this was a 61.8% retracement right back up into here. You can also use these numbers to project. If you do, if you looked into Fibonacci projections, I do, I've always felt that if I can get a price target from multiple methods that agree, then I have more confidence in it. Frankly, I think that, trading or investing is all about the confidence you have in your methods. So, I teach people, I say, here's the tools I use. So, those are the ones that I believe work, and I've proven to myself they work, but they're not going to be really of use to you until you look at them and study them and convince yourself. I've been teaching technical analysis, I think, since '83, I guess, was my first presentation. And so I hate to think about how many. As Paul was kind enough to mention, I do have a bunch of articles in Forbes, and I always tell anyone, if you ever have any trouble sleeping, I think I now have 1,500 and some articles up there. So I'm sure one of those will put you to sleep, and maybe more than one probably. But in any case, so Fibonacci projections. So you look at this rally here, and so if the decline, from this high equals the rally, then that's sort of your equality point, 1-to-1. But if you go 1.618, an extension of that, you get a target here of, in this case, of 91.69. We met for a little bit, two times it, 2.618 times it. So that stuff does really work. So if I can give a start band level and a Fibonacci projection level, and I'll talk in a few minutes briefly about pivots, if they sort of coincide, then that's a price level that I think I should pay attention to. So here's some of the comments I thought were hilarious. From 1929, 1st to February 2nd. So, remember, this is the rally that peaked. So, this is the bear market low is back in here. So market recovering faster than expected. Easy money is driving a rapid recovery. We've seen this just, a month and a half ago with the Fed, and this is my favorite, March 4th. It was in the financial press. That 1929 thing wasn't a crash. It was a buying opportunity. Fed is absolutely sure the economy is rock solid. More green shoots. I was laughing. I had lunch with some people about 3 weeks ago, and I'm saying, because right at that point, there were a bunch of articles in MarketWatch about guys talking about green shoots. And now I heard it on Bloomberg and CNBC just recently. So, but wait, are the fundamentals really that good? That was the end of it. Basically, that was the thing. So it's really odd if you go back and you're fortunate with the internet, you have the capability to pull up what people are saying. So if you look at, 2008, you see some similar sort of commentary. This is that low we talked about, 20%, only 20% were bullish down here. You get the rally. Investors try to look beyond weak reports in housing and consumer confidence. Now it's sort of, investors try to look back past the second quarter earnings and the impact of the virus on the world and the economy to the end of 2021. You got this thing. Stock spiked yesterday with the Dow rising almost 250 points, better than expected profit reports. Well, as a technical analyst, I mean, people who follow, just start following me, and if I talk about a company, they'll say, well, what does it do? And I usually just tell them, I may know, but if I don't, I just say, well, really, it's not pertinent to me, because I look at the technicals, and they kind of, that drives a few of them away quickly. So back in here, so May 6th of 2008, that was, you recall, that's when the bullish sentiment about peaked around 53%. At that point, of course, oil was like 120 bucks a barrel. So investors looked past record high oil prices and big losses at financial firms, and instead continued to bet that the economy is stabilizing and the worst of the credit crisis is over. Of course, it was just getting started, and then blue chips were stay buoyant was right at the peak commentary. These are taken from, CNN, I think, the CNN money side at that point. So in addition to, the AD line, when something I won't really talk about today, but I'll point it out, and I'll show you if you're interested. There's, I was kind of mentioning, I do have a bunch of videos on YouTube about these very methods. So the two main indicators that I look at in looking at ETFs or stocks are the relative performance. Okay, that's the ratio of an ETF or a stock, in this case Amazon, to the S&P 500. That's the benchmark I follow. So, this red line is that ratio. So my view is that in a positive market, you want to be in those stocks or ETFs that are outperforming the S&P. A couple of things happen when you're in those. Generally, if there is a pullback, that stock or ETF will be much better supported than one that has weak. For example, and early in the bull market in 2012, everyone thought the banks better do something, but the relative performance of the banks, the big banks, General Morgan, JP Morgan, et cetera, Chase, they all look poor. And it was not even, this does not give you the direction. It's just the relative performance. So it's not, you can have a falling RS and have a market still move higher. It's just you're looking at comparatively to the S&P. Now it becomes a little more problematic when the S&P is as strong as it has been lately, because very few stocks will be performing more strongly than the S&P. So once again, 21 period weighted moving average. So this was in the fall of 2018. We got up near the upper Stark band, so I had a client in here that I was, suggesting he get out of his Amazon because it looked pretty bad, and that was sort of the reason. Down below this is the Unbalanced Volume, which is my favorite volume tool. When I changed careers, my father actually had 2 copies of Joe Granville's book, Unbalanced Volume. He and I used totally different methods in using it. He was a real character. Unfortunately, passed away just not too long ago. I'd met him a couple of times, and he was used to appear in Vegas, if you can imagine, in the early 70s, and do a sort of Vegas show based on market analysis, which was somewhat very off color, but pretty funny. So I use the same sort of moving average, on the OBV, looking at, trend lines. So if you connect these 2 peaks here, you can see that right around in here, the thing's turned around. So again, these are the Stark bands, which I'll give you the formula here. So they're quite important. They keep me out of a lot of trades, and they also, tell me when, not to do anything. This is the gentleman who, late Manny Stoller, who developed the Stark bands in the early 80s. This is Tim Slater from CompuTrack and his late wife, Willa. I think this was in Istanbul at one of our speaking trips overseas. As I mentioned earlier, we used to do 6 or 7 cities. So I think this one we went Vienna, Geneva, Bahrain, Abu Dhabi, Riyadh, Athens, and Istanbul. I think this was the last stop. In any case, Manny was quite a trader. And so this is the formula. Back in those days, people were looking at, this is the same time that John Bollinger, another old friend, developed Bollinger Bands. They were looking at moving average percentages above a moving average, but they really didn't work, and you had to adjust them. So he developed this, and if you read anything on the internet that says they're the same as Bollinger Bands, go on to another article or look at yourself, because they really are different. They tell you, as I said, whether you're in the probability range of a market. Same formula, whether you're using, they work really great. I know a lot of futures traders that use them on hourly S&P data or even 15-minute. So the upper Stark band uses 6 period moving average And I put period because it's 6 hours, 6 days, 6 weeks, 6 months. And to that, you add 2 times the 15-period average true range. Average true range formula developed by Wells Wilder, the ATR. So that gives you your upper band. And then the lower band, is the 6-period, subtracting that. And you can look at, Manning said if you take 3 times that, he thought it was about 99% of the price activities. So like, when you're up near those, and like anything, hourly is not as significant as daily. Daily is not as significant as weekly, and weekly is not significant as monthly. So the only place they're available for free is on Yahoo. So this is a Yahoo chart. You can see 15-period average true range, 6-period moving average, 2 average true range. This is a weekly chart of Apple just to show you, like, and this is in the fall of 2018. So we're up above that upper band before that last quarter decline. When the market was bottoming out down in here, we're down below those bands. So just before, in January and February, above the band. And you have to realize when you're looking at this, it's a little sort of esoteric, but so any point in time, so if you're looking at the data, you're projecting what the bands are going to be the next week. So graphically, you don't show that you're exceeding the bands, but in reality you are, because you have a fixed number that's based on this month's data. So like we were really above the bands here, 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 and here. And you see that sort of thing. It's you're on borrowed time. So this is, I talked about this early in this year. So this is the Qs. You can see back in that correction we talked about in May, June, got right back down to below the lower band. And most of the year, sometimes you're in between there. So I look every week and a couple times a week, what the relationships are to those bands. So you're in the mid-range, it's a tougher call, but you know that you're not in the extreme. What happened early in 2020, we started getting above this, above the bands for most of the time. And, finally, the trend reversed, which was not too surprising. And so right now, now the Qs, I'll show you a current chart, we're up or close to the upper bands again. Gold is a really good market for this. This is a monthly gold COMEX futures. You can see 2006, 3 or 4 months above it, a 6-month correction. 2007, above, bam. This was a pretty severe correction. We went from, I think, 1,000 down to 730 or something on this one. So it's, a 25% move. This was the classic, in August and September of 2011, pushed way above the monthly Stark bands in both August and then early, I think we peaked out like around September 10th. And that was just a bearish sign. And you can see that was the start of the major decline, So when you get to the lower bands, 2 things are likely. You're either going to move sideways or you're going to move a contra trend move. And so if you get a contra trend move, and if you look on a weekly, that if you haven't seen a rally or a rebound, a move in the opposite direction in 2 or 3 weeks, it becomes less likely. So I think they're a pretty valuable tool. Also, I like pivot analysis. This goes back to that, the peak in May of 2008. You can see these. So the red line is the monthly pivot resistance. This is the R1, R2. Blue is the pivot. And here we have, the S1 and S2 levels. So I look at these, when you see a transition. So right in early June, this is sort of a pattern. You see both things. You either bounce up to the pivot the next month, because, those of you who don't use pivot analysis, it's pretty standard formula you can find online. But basically, all these levels here are developed by this month's price activity. So I look at it on monthly and quarterly. So it's based, once again, it's one of those different, it generates numbers you won't really see from a moving average oftentimes or something else. So when you see a rally up to that pivot level, and you have some negative signs like we did from the MACD and the AD lines in June of 2008, you're kind of in trouble. So it's something I watch. You can get them on stock charts as well, So let's look at the current here. So this chart is as of, as of last Friday. So New York Composite again, Stark bands, it's the weekly chart. So we got really oversold here. And the AD line, this is not too often. We moved above the AD line right around in here and started to pull back. So this week right here, it looked like it was sort of the bear market rally was over. My kind of line in the sand, at that point was this 12,074 level. That was overcome last week. You can see last week's bar, we closed well above it. We're at 12,641. And now you can see that the upper band here was at 13,064. So we've gone from, very oversold, mid-range, getting to be overbought here. AD line has made a new high here. So that's pretty positive, but to me, I base a lot of what I do on risk. So, when we're starting to turn positive, we'll show on the daily chart up in here, I expected that I underestimated the potential upside of the market. So I was therefore more cautious than I obviously in hindsight should have been. Let's look at the Qs. You can see similar sort of retracement levels with 210. So we hit that early, and now we're at 239. AD line here, it did not. When the other AD lines dropped below their moving averages, both the S&P, then the Dow, pretty much 5 of the 6 I follow did violate the weekly moving average that week. The NASDAQ 100 did not. And it's, still the star performer, but it's getting up there. It's made this week, of course, it's made a new high. So you can see that each week with 261, is the upper Stark band. You can see what happened here with the Qs, what happened. So, we may not stay above it for 3 or 4 weeks next time around, or we could. This looks at the daily, so you can give you sort of the transition sort of thing that we looked at before. So no divergences up here. We broke through that Monday, broke through the moving averages, and it was just like, nothing really in towards of a bottoming action until right around in here. The daily started to turn around. And then, the next resistance level wasn't really, this is when the weekly on April 17th moved above its moving average at that point. And since then, it's been a really, the 20-day moving average is a little in the way of pullback. And you can see that, when you see this sort of trend, it's really, suggests other than some sort of huge shock, it's going to take a while before it tops out here, given this chart is as of, this is as of Friday's close too. So it's still strong this week. S&P, little different picture. It was looking, you can see that it had a rally failure on May 8th, dropped back below its moving average, and then flipped back to positive. And now, of course, has joined the party. It's still not made a new high. And the AD line has not made a new high. So it's going to be really interesting if we get back up here and we see any sort of downside reversal. If we have that non-confirmations in different averages, be something I've been watching. Here's the daily pattern also for the S&P, similar sort of thing. You got, down to the lower Stark band the first day off the gate, but really, the AD line was just like, wow, watch out below. And pretty much, the overbought readings, I wrote a lot of articles about measures that I thought that was in historically overbought levels. So most of my stops were hit on that Monday, and some were hit the week before, but pretty much, it was a bloodbath. And I didn't expect some of the declines we saw, certainly, different pattern here you can see, and you can look at this again, as I said, in stock charts. But if you draw an uptrend connecting these two lows, we kind of got violated right here as we had this sort of bearish pattern, right into the Stark band. I think it was May 14th. That looked like we could see a rally, and then, similar to what we saw in 2008, the market would collapse, but that has not been the case. If you want some more, there's a bunch of articles. I put out regular videos of my thoughts on the markets, etc. Not a little advertising at the end of each one, but other than that, I usually try to keep it to under a minute. So, only there's no subscription, no charge or anything. The only advantage of it really is that you get, when I put a new video up, about it before anybody else. It usually takes me a while. So, questions, comments? I'm open the floor.
Well, first, I'd like to thank you, Tom, very much for that presentation. It was great. A lot of material in there, very, very interesting. We have one question. Can you expand on your use of timeframes, weekly to daily, as sometimes contradict each other? Great talk.
Yeah. Good question. Yeah. So particularly it's interesting on something like the unbalanced volume. Regularly, you run into where the unbalanced volume looks, either really strong on a weekly basis and weak on a daily basis, or it looks really weak on a weekly basis and looks really strong on a daily basis. Generally, if I'm looking to take a position, I go with a longer term time frame. If it's something that's, could turn, so the best signals I find, so I do scans every week. So I look for, signs where, I don't think we have any, let's see. I didn't include too many market. So, when you get sort of like, hard to tell here, but the sort of pattern when the OBV, changes a trend and then sort of bounces back on its moving average on a weekly basis. So I look for patterns like this, when the ranges are really tight because it allows the risk, and you start to see, flips where it flips down to its moving average and flips back up on a weekly basis is generally the best. But I find that, if I'm basing something off a daily, that's in contrast to the weekly, I usually use much tighter stops. Because in the back of my head, it sort of looks at the dominant trend there is a weekly, and the dominant trend, is giving me a conflicting signal. Then I don't want to be greedy, and I tend to, if I'm fortunate enough to pick a stock that that goes in my direction, I usually try to take if I'm lucky enough to get a 10% profit, in a week or so, I take that. I'll take half the position, raise the stop on the other half, just so I don't, so I have that net on the first half and move forward, towards the money management. Mm-hmm. Because I find that, too many people have too high expectations of what their profit potential might be, and therefore they get them into trouble. That and entry levels. I really done a lot on entry levels, but I spend more time on entry levels than anything else. So I look at, for example, and I think there's maybe some things on YouTube, but for example, if I look at I don't see any clearly ones here, but if you see, I look at a weekly range and then look for a pullback within that weekly range, the next range, to say, well, okay, if if it had a $5 range the week before and I'm bullish on it, then I'm going to try to buy it at $2.50 below the high for an entry point. Always looking to get a little pullback, within an uptrend or a rally within a downtrend.
Right. A clarification from me is you use the advanced decline line for looking at indices, and you use the unbalanced volume to look at individual stocks, right? Or
correct. Yeah. I use the advanced decline line just for the general trend of the stock market. So also, mutual funds, ETFs, etc. And, on across all time frames. Then for individual stocks or ETFs, I use a combination of the RS, the relative performance, the ratio of that, and the unbalanced volume as my key tools. I do look at some other momentum indicators like the MACD, but generally, I find too many people use, the CCI, the Williams, the RSI, and the MACD, all basically looking at the same data. They're both all looking at the price action, and so sometimes you get the same, same information. So I like the volume aspect when it's available. Right. In commodities, there's something called the Herrick Payoff Index, which uses price, volume, and open interest to determine money flow. I think if you search on HB, I think I'm the only one that ever writes about it. It's pretty interesting. It's pretty good on crude oil and gold. I use that. But basically, right. Aiden, you have a very nice picture behind you. So I'm sorry you weren't able to speak, but I like your artwork.
So you talked about a number of indicators you use: the advanced decline line, AAII, MACD, Fibonacci, Stark. You use trend lines, pivots. You use headlines and unbalanced volume. So in general, do you like looking at a number of these indicators and getting confidence with them, or do you use very rigid rules that you follow, or more discretionary?
Probably more discretionary. I mean, basically, it's sort of a process. So I do a lot of my work on the weekends. I mean, right. For many years, I mean, I start working probably 6 a.m. on a Saturday morning and work pretty much towards the weekends are not time off for me. Basically, I look at a bunch of scans of, so like this last weekend, I probably cut it down to about 80 different stocks I was looking at as potential to recommend, this week.
Mm-hmm.
And, it's sort of, so it's a stepwise sort of process. First of all, I look at the chart pattern. So if I see something that is just, has moved sharply higher and it's well away from like its 20-week moving average or close to its stark band, it's not something I'm going to buy. It doesn't mean it's not going to go higher, but I just know that the risk parameter is not, favorable for me. So I look, kind of quickly at the chart, look at the unbalanced volume. So that's kind of the initial scan. So, given those 80 stocks, I probably came up with 10 or 12 that looked interesting to me. Then I go more into the more in-depth. So I look at the weekly, then I look at the daily, and, a lot of the stocks, of course, with last Friday's action, they were up near the, the upper stark band since they were overextended. So then I kind of look at, well, okay, where can I place a stop, that's going to be safe? Okay, and then where can I enter so I can keep my risk to under 5% or under? And that kind of is the next process. I really don't use headlines much at all, other than almost a contrary indicator, in terms of my, in my analysis. There's sort of like a set of stuff. The AD line, of course, is the market direction, is the most positive. So if it's daily and weekly are positive, then, I'm a buyer, basically, until that changes. I'm developing a risk monitor that's kind of based on the stark bands, based on the number of stocks in terms of the stock market that are above their 50 and 200-day moving averages, because those I find to be quite useful. Like right now, like 90 some odd percent of the stocks in the NASDAQ 100 are above their 50-day, and probably 80% are above their 100 days. So when that gets really high, there are a smaller universe of stocks that haven't moved. So that cuts down in my pool, if you will, ones I'm interested in. So, the sentiment numbers, all those things, they're kind of things I look at, at what I consider turning points. But not on, don't really use those to determine individual positions. Right.
There is a question here. Have you ever looked at whether this same type of analysis that you use, and I'm assuming the AD line or some of the indicators you use, apply to intraday trading?
Yes. Yeah, I have. I mean, I could have brought a chart, but yeah, part of what I, when I, over the years, done a lot of work with the AD line. So, if you have, there have been a number of examples, where, so if the daily AD line is positive in the market, like the SPY or something is consolidating and pulling back, so we have like a couple of day pullback, what oftentimes I will notice, and, my students have observed this and actually emailed me at the time. So, you're looking for sort of a pullback, and then, say, the market's down Tuesday, maybe there are, 1,000 issues advancing and 2,000 declining. Wednesday is down, maybe it's, 1,600, or 1,200 up, 1,800 down. Thursday, I find pullbacks when an uptrend or rebounds when the downtrend often last 2 days. So then Thursday, you see it's afternoon and the market's down slightly, and you have like 2 or 3 hours of trading lift. You can see that, okay. And we had a couple examples like that in the last week where the averages were down, but the AD lines were positive. So it's like 1,600 issues up and 1,000 down, but, the S&P may have been down, 20 points or something. So that allows option traders to have a pretty good opportunity to buy options when there's not a lot of premium in them. Right. So that's or by the underlying indices. So you can't really plot the AD line, but you can see what it's doing in terms of the bigger trend. So that, that symbol on stock charts, it's updated, during the day. So you can see sometimes when it's diverging from the price. Unfortunately, they don't allow you to plot it hourly, but you can plot it daily, and it is pretty interesting.
Right. And the last question, you mentioned using MACD on Forex way back when no one was using it. There's a question: do you still trade Forex?
No, I don't. Right. I used to do institutional advice on Forex, and so back this is before they had platforms. So I'd be calling you guys, in the middle of the night if I'd have to call Rothschilds in Singapore to place a trade and stuff. So it was pretty hectic. One of my better known calls, if you will, was that the Unbalanced Volume in May of 1985 gave a really bullish signal. There's a bullish divergence. I don't even know if you can find the data. So I was on what is now CNBC, and I was saying that the dollar had topped out. and there was really strong signals. Of course, in September, they had the Plaza Accord where all the governments decided the dollar was too strong. And so, that was a really nice leading, I was looking at the weekly Unbalanced Volume and the Deutschmark and the Swiss franc, et cetera. And they had all looked like, okay, the dollar's finally had it. And I was often, when I was doing that trip to Saudi Arabia, I had all these engineers in the crowd. So finally I asked them, I said, well, what are you doing mostly they were foreign exchange managers and traders and things. And what are you doing here? And they'd had a contract to build this causeway between Saudi Arabia and Bahrain. And the contract went into like November, that I mentioned, of when Reagan was elected, and they made so much more money on the exchange rate than they did in the project. They figured they had to understand what drove exchange rates, because they wanted to understand, and they thought it was much more profitable than building things. So, and no, I don't. The Stark bands work really well on foreign currency. So I suggest, and you probably can input them into like some of the more common platforms. It's just for some reason, like stock charts, you can't. It's one little tweak. So if you look at Keltner channels on stock charts or a lot of platforms, they like in stock charts, they only allow an exponential moving average instead of a simple moving average. So that skews it. But you can change the same parameters. So it's a 6-period moving average, 15-period 2 range, and 2 times the day. You'll get an approximation of the Stark bands.
Right. Excellent. Well, there were many good comments, and thank you from people. We invited our friends from Australia, from the ATAA, and many of them saying hi from Australia and thanking you for this very interesting presentation. For anyone who's interested, Rachel put in the comments, you can go to STANZ.co.nz if you're interested in joining the Society of Technical Analysts of New Zealand. And also, Tom, you've shown in the presentation your own YouTube channel. You've got your Viper report website and your articles on Forbes that anyone can go and check out. And I think this was a great session. I really want to thank you, Tom, for doing this for us. First time we have a presenter from US, and hopefully it won't be the last one.
I hope not either, Pablo. I'd be glad to join you again sometime. Thank you for thinking of me. And I'd encourage all those people who are not members. I've had the pleasure of speaking to technical analysis groups in a number of foreign countries in written form. And, that's really a good resource. If you're interested in the markets and you're not in that group, briefly, those conferences that I used to, the TAG conferences, were sort of similar. And I found that, you may hear something I talked about and have a slight modification of it, or say, hey, how am I going to apply this to something else? You may come up with better, something that's even more interesting than what I'm talking about. So you get those ideas that are create a fertile environment to improve your trading and investing. So I hope you'll all join.
Perfect.